taking a look at Wall Street. You're going to hear these numbers and you're going to think, oh, nothing happened today. Wrong. Dow Industrials down 6 at 12,653. S&P 500 down 3 at 1,313. NASDAQ Composite down 4 at 2,811. Yield on the 10-year note down 6 basis points at 1.84%. So pretty substantial move there. Oil down 61 cents at 98.94 per barrel. And the metals moved a little bit lower. No big deal. So you look at the Dow down 6, S&P down 3. Nothing going on today. We were down a bit earlier. The market moved lower this morning. The Dow was down over 130 points. The justification was that Greece had not resolved its debt crisis. That's what I was reading this morning. The 27 nations of the European Union held their 17th summit in the past 2 years. The Greeks have been trying to put together a deal with private bondholders to restructure about 200 billion euros worth of debt. But they couldn't come up with a completed deal. I know, you're shocked. Me too. I know. I'm shocked. It's amazing. 17 summits, 2 years, no deal. Not yet. And the EU leaders can't do anything until a deal gets done in Greece. And to push things forward, the Germans proposed a European commissar take control of Greek public finances to ensure that Greece meets its fiscal targets. Greek finance minister said that to make his country choose between national dignity and financial assistance ignored the lessons of history. The German call won some backing from the Dutch and the Swedish prime ministers. And apparently everybody forgot that the EU has already installed an unelected technocrat to run Greece. Prime Minister Lucas Papademos. Not a democratically elected prime minister. I mean, what do they want? They want a prime minister and a commissar? Oh, we need a commissar. Yes, because the technocrat prime minister we installed hasn't gotten the job done. Oh, come on. And then the Europeans talked about increasing the bailout funds to make at least $1 trillion fire ring around the economies of Portugal and Ireland and Greece, hoping that the default problem doesn't jump to Spain and Italy and get out of control. Treasury Secretary Tim Geithner went to the World Economic Forum in Davos, Switzerland on Friday. He said he wants the Europeans to come up with a bigger, more credible firewall. Yep. Shocking. Absolutely shocking. And as the day dragged on, the stock market realized it was all just Europe being Europe, and equities nearly recovered. Geithner, by the way, talked more about the bigger, more credible firewall. He had a few other things to say. He was interviewed when he was in Davos, and he discussed the critical risk facing the American economy this year. And Geithner said the critical risk, the two big critical risks, the European sovereign debt crisis and the rise in tensions with Iran that might result in a jump in oil prices. Yeah, okay. Those are certainly risk. He forgot, apparently, about jobs and wages back here in the USSA. Not a particular risk, apparently. America now produces more than it did when the recession began, but it does so with about 6 million fewer workers. For all of 2011, incomes fell 0.1%. Consumer spending picked up slightly in the fourth quarter, mainly because consumers drew down their savings. That sounds a bit risky to me. But it's easy to forget what's really important. It's easy to forget who you work for. especially when you're in Davos. A week before MF Global Holdings Limited collapsed, its chief financial officer told Standard & Poor's in an email that MF Global had never been stronger. That was the quote, never been stronger. S&P provided the House Financial Services Subcommittee on Oversight and Investigations with an excerpt of the email from MF Global CFO Henry Steenkamp. S&P also informed the panel that John Corzine, who was MF Global's chief executive officer, met with S&P analysts on October 20th to reassure them that his $6.3 billion bet on European sovereign debt was no threat to the firm. Lawmakers in Washington turning their attention to the role of the ratings companies in the failure of MF Global. They'll be meeting on the 2nd. Thursday. The bankruptcy trustee of MF Global's U.S. brokerage unit has returned about 72% of the money in customers' U.S. accounts when MF filed for bankruptcy at the end of October. But by contrast, all of the money of U.S. customers invested on foreign exchanges through MF remains frozen. And officials are still hunting for $1.2 billion in missing customer money. And they say, man, it might never be recovered. The findings so far suggest that a significant amount of money could have vaporized as a result of chaotic trading at MF Global during the week before the company's October 31st bankruptcy filing. That's what they said in the Murdoch Street Journal this morning, that the money could have vaporized. That's a very interesting concept, that money can just vaporize. And some people, we were talking about it around the station today, some people question this idea. They think that vaporizing money is just a euphemism for stealing money. It might be. But think about it. If the Federal Reserve can create money out of thin air, then it makes sense. Ashes to ashes, dust to dust, thin air to vaporization. Why not? This is the problem when money isn't real in the first place. Poof! It disappears. Happens to us all the time. Let me give you an example. A couple of months ago, I bought a tank of gasoline for $50. This week, I bought a tank of gasoline for $55. Same amount of gasoline, same gas station even. What happened? My $5 vaporized. This is money that the Federal Reserve created out of thin air, and it's gone. Money managers raised their combined bullish positions across 18 U.S. futures and options by 13% to 742,902 contracts for the week ended January 24th. This according to the Commodities Futures Trading Commission. The net long position in copper was up 53% to the highest since August, and in silver, the net long positions increased 22%. It's the most since September. Speculators also expanded their bullish bets in sugar, soybeans, cotton, gold, gasoline, and crude oil. State and federal officials are close to an agreement with the largest U.S. banks over mortgage abuses. States are looking at an end-of-the-week deadline to decide whether they're going to sign off on this. The final value of any settlement depends upon which states actually do sign off. For example, if California doesn't join in, then the whole settlement could drop off sharply. In a sign that the deal is close, negotiators have agreed on a guy by the name of Joseph Smith, North Carolina's banking commissioner, as a monitor to ensure the banks comply with the terms of the settlement. There have actually been several settlements with the banks regarding mortgages. It's just that most of them, they just look past them, don't do anything, and nobody enforces it. But that was a sticking point, apparently, was finding someone who would serve as a compliance officer, if you will. The banks in the talks: Bank of America, Wells Fargo, J.P. Morgan Chase, Citigroup, and Ally Financial. The proposed settlement releases the banks only from civilian claims of errors in servicing and originating the loans. The deal could be up to $25 billion, but a lot of that's going to come in the form of cutting mortgage debt for homeowners who are underwater or otherwise distressed. It's not really going to be cash from the banks. The banks will resolve civil, state, and federal lawsuits about servicing misconduct and faulty foreclosures, and state lawsuits about how they made some of the loans. President Obama, in the State of the Union speech last week, directed his Attorney General to create a new working group to help turn the page on an era of recklessness, the idea being that there might still be investigations into misconduct that fueled the financial crisis. And if this settlement goes through, and I expect that it will, then there will be more modification and foreclosure activity in coming months. And this is just one of several policy changes in the works, including the HARP refinance program starting in March, possible GSE REO to rental program. Federal Reserve also looking at issuing guidance to banking organizations and examiners to allow banks to rent more residential REO. So we'll see how that goes.